Welcome to The Explainer. Today, we're diving into a classic guide to investing. We're going to take what's called a random walk down Wall Street to uncover a strategy that, believe it or not, has consistently outperformed the so-called experts for decades. So let's just get right to it. Is Wall Street a game you can actually win? I mean, for a lot of us, it feels like this big, scary, chaotic mess. Maybe even a little bit rigged, right? But what if there was a way to cut through all that noise? Well, in this explainer, we're going to break down a really powerful strategy that can help level the playing field and put the odds back in your favor. Okay, so let's start with the biggest, most shiny temptation out there for any investor, the dream of getting rich quick. The famous economist John Maynard Keynes had this perfect phrase for it. He called it building castles in the air. It's an idea that pulls you in, but trust me, it's one of the most dangerous traps you can fall into. So you've basically got two competing mindsets on Wall Street. On one side, you have the firm foundation theory. This is the idea that a stock has a real, solid, calculable value based on its business. Its assets, its earnings. But on the other side, you've got the castle in the air theory, which says a stock is only worth whatever the next person is willing to pay for it. It's really a battle between cold, hard logic and mob psychology. And listen, this whole castle in the air thing, it's not some new phenomenon. The psychology is totally timeless. Let's go way back to 17th century Holland. People got so swept up in speculation that they built a castle in the air out of tulip bulbs. It got so crazy that a single bulb was selling for the price of an entire house. And then, just as quickly, the whole thing crashed, wiping out fortunes overnight. Okay, so you might be thinking, that was the 1600s, things are different now. Not so fast. Let's jump forward to the dot-com bubble of the late 90s. The tulips were just replaced by tech stocks, but the story was exactly the same. You had companies with basically zero profits, like the Globe.com, with stock prices built on nothing but pure hype. And just like before, that castle burst, vaporizing trillions of dollars and proving human psychology hadn't really changed at all. Now, if you're sitting there thinking, I'm way too smart to fall for something like that, well, let me hit you with this quote. This came from Sir Isaac Newton. Yeah, the Sir Isaac Newton, one of the greatest scientific minds in all of history. And he said this right after he lost his own fortune in a market bubble. He learned the hard way that predicting human madness is a whole lot harder than calculating the movement of the planets. So, okay, if chasing those crazy bubbles is a total dead end, what's the alternative? Well, maybe we should just listen to the gurus, right? The experts, the pros who claim they've cracked the code and have a system to beat the market. Let's dig in and see if that's any better. And when you look at these so-called experts, they pretty much fall into two main tribes. First, you have the chartists. They're obsessed with looking at past price charts, convinced that patterns from the past will predict the future. Then you have the value hunters. They act more like financial detectives, trying to dig deep into a company's books to figure out its one true intrinsic value. Okay, but here's the kicker. The dirty little secret. The hard data shows that these fancy approaches, they just don't work consistently. For the chartists, as soon as everyone sees a pattern, poof, it disappears. And for the value hunters, their forecasts of a company's future earnings are famously, almost comically wrong. And the worst part? Study after study shows that the vast majority of professional fund managers can't even beat the simple market average. So after all that talk of failure, of traps and gurus who can't deliver, it all leads us to the book's big core idea. And honestly, it's a huge relief. It's a concept that frees you from having to be a Wall Street wizard or chasing after the next hot tip. And here it is. It's called the random walk theory. Now, the key insight here isn't that markets are just pure chaos. It's actually the opposite. They are incredibly efficient. So efficient that by the time you or I hear a piece of news or read some hot analysis, that information is already baked into the stock's price. And that makes the next price move, essentially random and unpredictable. Okay, so if you can't consistently beat the market, what on earth are you supposed to do? The answer, it turns out, is beautiful in its simplicity. Stop trying to outsmart the market. Instead, just buy the market through a disciplined, low-cost strategy. And the tool, the absolute no-brainer weapon in your arsenal for this, is the index fund.
See, instead of paying some guru a ton of money to try and fail to pick winning stocks, an index fund just buys everything. It buys all the stocks in a major market index like the S&P 500. You are guaranteed to match the market's performance, you get incredible diversification, and you do it all for rock-bottom fees. But does this stuff actually work in the real world? What does it mean for your wallet? Just look at this number. It's kind of staggering. According to the book, this is how much extra money an investor would have made by simply putting 10 grand into an S&P 500 index fund compared to the average expert-managed fund over a 45-year period. That's the mind-blowing cost of trying to be clever. So this is it. This is your 4-step playbook. And notice, it's not about being a genius or having a crystal ball. It's all about discipline. First, figure out how much risk you're comfortable with. Second, diversify your money across different assets using those low-cost index funds. Third, once a year, just rebalance your portfolio to get back to your original plan. And fourth, and this might be the hardest part, stay the course. Ignore the noise and trade as little as possible.
And really, if this whole explainer boils down to one single idea, it's this. This quote from the author himself. The secret to building wealth isn't about trying to time the market, jumping in and out at the perfect moment. It's all about time in the market, letting your money work for you over the long haul. Patience is the real superpower here.
All right, to wrap things up, let's talk about a classic little paradox. It's kind of a finance professor joke, but it makes a great point. So the professor, a true believer in efficient markets, says the $100 bill can't possibly be real because if it were, the market would have already picked it up. Of course, the student should grab the money. And the point is, while the market is highly efficient, it might not be perfectly efficient. But the winning strategy isn't about running around looking for those rare $100 bills. It's about having a plan that works even if you never find one.
And that's a wrap on this explainer. We really hope this gives you a clearer, maybe less stressful way to think about your own financial journey down Wall Street. Thanks for joining us.